Morning student, welcome to online classes. This is Shubha Shukla, your accounts teacher. Today we start our new topic, that is accounting treatment of goodwill. In previous video we studied about the concept of reconstitution of partnership, meaning of change in profit sharing ratio among the existing partner, and determination of sacrificing and gaining ratio. So let's start with our new topic, that is accounting treatment of goodwill. A change in profit sharing ratio basically implies that some partner will gain more share in future profit while other will lose. Thus, the gaining partner must compensate the sacrificing partner by paying the proportionate amount of goodwill. In other words, the gaining partners should be pay the sacrificing partner the same share of goodwill which is equal to the share gained by him. In this case, firstly calculating sacrificing and gaining ratio, and then following journal entry will be recorded. So accounting treatment of goodwill is gaining partner's capital account debit to sacrificing partner's capital account, being share of goodwill adjusted between existing partner in gaining or sacrificing ratio. Compensation amount for goodwill is equal to firm's goodwill into gaining share of partner. That is firm goodwill. These treatment for the firm goodwill. Now next one is existing goodwill, that is book goodwill. It also written in balance sheet. It should be written off by debiting goodwill to existing partners' capital or current account in their old profit sharing ratio and crediting goodwill account. Existing goodwill appear in the balance sheet of firm should be written off by debiting goodwill to existing partners capital account in their old profit sharing ratio and credited to goodwill account. Accounting treatment for existing goodwill is old partners capital or current account. If capital is fixed, then we have to return here current account, and if capital is fluctuating, then old partners capital account debit to goodwill account, being existing goodwill distributed in old profit sharing ratio. One example is there. For example, A, B, C are partner. Their old ratio is 5:3:2, and they decided in future profit equally. For this purpose, goodwill of the firm is valued rupees 2,40,000 and existing goodwill of the firm is rupees 80,000, that is book goodwill. That will is given in balance sheet. Pass necessary journal entry for the treatment of goodwill on change in profit sharing ratio of A, B and C. These are three partners. So firstly we have to for calculating the firm goodwill, firstly we have to calculate sacrificing ratio. Sacrificing ratio is equal to old minus new. So A's sacrificing ratio is equal to 5/10 minus 1/3. A's old ratio is 5 plus 3 plus 2 is equal to 10, that is 5/10, and 1 plus 1 plus 1 is equal to 3, that is 1/3. LCM of 10 and 3 is equal to 30. So amount will be 15 minus 10, that is 5/30. A sacrifice their share. Now B share of sacrificing is 3/10 minus old is 3/10 and new is 1/3, that is 9 minus 10/3 is equal to minus 1/30. Minus will be gained. So B gain the profit sharing ratio. C share of profit 2/10 minus 1/3 is equal to 6 minus 10/30, that is minus 4/30. C also gain their profit sharing ratio. Now compensate the amount. So firstly we have to calculate A share of goodwill, that is firm goodwill into sacrificing share, and B's share of goodwill is equal to firm goodwill into his gaining share, and C's share of goodwill is equal to firm goodwill and his gaining share. Now calculate A share of goodwill, that is 2,40,000 into 5/30, that is 40,000. and B share of goodwill is equal to 2,40,000 into 1 upon 30, that is 8,000, and C share of goodwill is equal to 2,40,000 into 4 upon 30 is equal to 32,000. Now journal entry for firm goodwill, date, particulars, LF, amount debit, amount credit. So journal entry will be gaining partners capital account debit to sacrificing partners capital account. Debit is receiver and credit is giver. Gaining partner is receiving the amount of share of goodwill and sacrificing partner is giver the amount of goodwill. So B is capital account debit, C is capital account debit, 2A is capital. B gain, C is gain, and A is sacrificing their share. That is 8,000, 32,000 and 40,000. Now next one thing is existing goodwill. So for existing goodwill, firstly we have to calculate existing goodwill in old profit sharing ratio. So A share of existing goodwill is 80,000 into old share is 5 upon 10. So 80,000 into 5 upon 10 is equal to 40,000. B share, old share is 3 upon 10. So B share of goodwill is equal to 80,000 into 3 upon 10, that is 24,000, and C share of goodwill is equal to 80,000 into their old ratio, that is 2 upon 10 is equal to 16,000. So journal entry for existing goodwill, that is A is capital account debit, B is capital account debit, C is capital account debit to goodwill account. So A share of goodwill is 40,000, B share of goodwill is 24,000 and C share of goodwill is 16,000. So total goodwill is 80,000. Now next topic is accounting treatment of reserve and accumulated profit and loss. If at the time of change in profit sharing ratio, reserves, accumulated profit and loss exist in the book of the firm, they are transferred to partners capital account if capital are fluctuating and current account if capital are fixed in their profit sharing ratio. The reason for such transfer is that these reserve and accumulated profit and loss have come into existence before the change in profit sharing ratio and hence belong to the partners in their old profit sharing ratio. The following entries are passed for treatment of reserve and accumulated profit and loss. Treatment of transfer to reserve and accumulated profits. Firstly, we have to calculate the accumulated profit. That is the treatment. Treatment means journal entry. Reserve accounts are debit, profit and loss, credit balance. Credit balance means profit. All the income and gain are credit. So profit and loss account, it means there is profit account debit, workman compensation reserve account debit, investment fluctuation reserve account debit to old partners capital or current account. Capital account if capital are fluctuating and written here current account if capital are fixed. Now transfer to accumulated losses. Old partners capital or current account debit to profit and loss debit balance is loss to deferred revenue expenditure account. Deferred revenue expenditure account is accumulated loss. Accumulated means undistributed. These are accumulated profit, reserve, profit and loss, workman compensation reserve, investment fluctuation reserve, and these are accumulated losses, that is profit and loss, debit balance and deferred revenue expenditure. These are distributed in old partners old ratio. These one are given in balance sheet. Reserves, all the reserves are liability of the business. That's why it was written in liability side. And these two items are these two undistributed losses or accumulated losses are given in asset side of balance sheet. If partners want to prepare a single entry for accumulated profit and loss, then firstly they have to calculate their net effect If net effect is positive, net effect means firstly we have to calculate all the profits and all the losses, then differentiate them. After the differentiation, if result is positive, means if profit is more than the losses, then result is positive, then entry will be gaining partners capital account or current account debit to sacrificing partners capital or current account. But if the entry will be negative, yeah, if effect will be negative, effect will be negative means if the losses is more than the profit, if losses is more than the profit, then if net effect will be negative. Now entry will be sacrificing partners capital or current account debit to gaining partners capital or current account. For example, A, B, C were partner in a firm. Their profit sharing ratio is 5:4:3. They decided to change their profit to 2:2:1 with effect from 1st April 2020. On that date, general reserve is rupees 3 lakh and debit balance of profit and loss account is rupees 4 lakh 80,000. Debit balance of profit and loss is accumulated loss and general reserve is a reserve for accumulated profit. Now, firstly, we have to divide general reserve and profit and loss in old profit sharing ratio, that is 5:4:3. General reserve is rupees 3 lakh. A share of general reserve is 3 lakh into 5/12, that is old one ratio. B share is 3 lakh into 4/12 and C share is 3 lakh into 3/12. A share is 1,25,000, B share will be 1 lakh and C share will be 75,000. Same as profit and loss debit balance is 4,80,000. It will also divided in old profit sharing ratio, that is 5/12, 4/12 and 3/12 into 4,80,000. So A share is 2 lakh, B share of capital is 1,60,000 and C's capital account is 1,20,000. Now general entry. So general entry for general reserve is accumulated profit. So for accumulated profit, entry will be reserve account debit to old partners capital account. So general entry is general reserve account debit to old partner. Old partner is A's capital account, B's capital account and C's capital account, being general reserve distributed in old ratio. So general amount of general reserve is 3 lakh. A's share of capital is 1,25,000. B share of capital is 1 lakh and C's capital account is 75,000. Now, for accumulated profit and loss, that is profit and loss account, for accumulated losses account, entry will be old partners capital account debit to profit and loss account, that is debit balance. So A's capital account debit, B's capital account debit, C's capital account debit to profit and loss account, being accumulated loss distributed in old ratio. So amount of A's capital is 4,80,000. B's capital is So amount of profit and loss is 4,80,000. A's capital is 2 lakh. B's capital is 1,60,000 and C's capital is 1,20,000. That is the distribution of accumulated loss and that is the distribution of accumulated profit.